My name is Brian Watkins, and this is a video tutorial for my Accounting 231 course on QuickBooks. And if you take a look at the screen, this is what you should have printed out to begin working on your homework assignment. It gives you some basic instructions about how to configure QuickBooks, which is basically an accounting software. You're going to do accounting now, right at the very basic level. We used to have bookkeepers that would keep general ledgers and the general journal in ruled paper, but now the standard is QuickBooks. So we're going to teach you how to use that this semester. You'll go and open it, and it's on the various computers in the library and GCB, QuickBooks Premier Accounting Edition. And when it comes up, it should give you a screen that invites you to open a new file. Now, if you see an update, do not install the update, because you have an imaged drive and installing the update won't do you any good. So just say install later. Okay. Now, if you see this no company open, you're going to create a new company. Or if that doesn't work, you're going to go to the File tab and hit New Company. Either way will get you to the screen that you need to be at, which is this screen here. Let me pull it down. It's the Express Start menu, so just hit it. Now the company name is always going to be your name. It's the only way you can keep track of all the homework. So no cute names here about Awesome Surfboard Company, because I can't tie them back to your name and you want credit for your work. The industry is given to you. I told you to open a general service-based business. There will be different kinds of businesses in different homeworks. Company type, sole proprietorship. Don't worry about the tax ID number, you can leave that blank. We'll continue. You can leave all of this information blank. QuickBooks is such a powerful program because it knows when to collect information that it's going to reuse over and over again. You're not going to need to redo this. Your job is to learn how to enter transactions. So you can leave this blank. And when you create the company file, be prepared to let your computer rest for a bit while it works. I'm going to click on it. Okay, it's been clicked. And what you can't see, I'll have to move up to it, is a little dialog. Here we go. It says creating new company file. Please wait. It may even say not responding. That my computer often says not responding. Just don't hit any keys. Don't click on your mouse. Just stand by and wait. QuickBooks will open up. It's just a lot of work being done. And when it does open up, it will want to give you some pretty much junk screens that you'll have to copy out of. Okay, so we're not going to do any of this because we're not starting from an existing company trying to put it into the system. We're starting from scratch. So we'll just say start working. Okay, and this is the default QuickBooks screen. And the choices that you see on the screen, let's get rid of the Quick Start Center. These choices are based on the kind of business that you opened. This screen can get very, very crowded depending on how complicated your business cycle is going to be. Now, if you look at the homework, it says go to the Edit drop-down menu. Drop-down menus are up here on the top line. Select Preferences. And from Preferences, go to Purchase Orders and Inventory, which is found in Items and Inventory, Company Preferences, Inventory and Purchase Numbers, Purchase Orders are active. Okay, we're just going to get in a good habit right at the front. It will want to close everything. Let it. Now when you see a blank screen and you need to get something done, don't panic. Just push the Home button. Okay? When you're lost, you can go home. That's not a drop-down. These are drop-downs at the top. These are just buttons. And for everything in QuickBooks, there's probably half a dozen ways to get there, which is why you just need to learn how to navigate through the interface and find which of the various means works best for you. Okay, so now that we've enabled purchase orders, we can start entering transactions. And if we come down here, let's look at the first one, February 1st, 2013. Your first transaction in any new business is usually going to be to put money in the bank. If you put your own money in the bank, then you're creating equity because you don't owe anybody any money. And the accounting equation says assets equals liability plus owner's equity. So if we want to look at owner's equity as net assets or assets minus liabilities, if you put your own money into the bank, that's your equity. We're going to do it differently in homework 1. We're going to borrow money from the bank. We're going to go to February 1st, 2013. Bank of Laie loans you $25,000 on terms of 5% compounded monthly and amortized for 4 years. Okay, so we're going to go, the first thing we're going to do is deposit money. And you do that at the bank. Record deposits. Remember where to find this because business is all about money, and that's where you go to make your bank account. It will say you don't have a bank account. Create one. Okay. Remember that an account type bank is very unique. That's your checking account. That's not any other kind of accounting account like an asset account or a liability account. This is just the bank account. You'll create it once, and that will serve to handle your cash. This is the deposit screen. So you're going to receive from, now a word about these boxes. Any box that has a down arrow in it is going to be trying to save information that you can recall later. If I just type the information, received from Bank of Laie, okay, it won't be able to find it well. So what we're going to do is we're going to do a quick add, put Bank of Laie in. Now I want you to think real hard. They're loaning us money. Okay, so for the purposes of this transaction, they're our vendor. A vendor is any business that we do business with. They're not our customer or an employee, and frankly, we're the only other. We're the owner. So Bank of Laie is a vendor. Now that's the quick add procedure, where you type and then you add it. The other thing you could have done is hit the arrow and clicked on Add New. Okay, there's multiple ways of doing things. What's the account going to be called? Well, I'm telling you in the homework, because I understand you're not all finished with 201, the account is going to be a long-term liability because the loan is longer than 1 year. If it were shorter than 1 year, it would be a short-term liability or a current liability. But since it's longer than that, we're going to create a new account. It's not listed here, so we're going to add new, and we're going to let it prompt us. That's a loan, so we'll continue. And the question is it current liability? No. It's a long-term liability. It's a long-term note. So we're going to call it a note payable, spell it right, payable to the Bank of Laie. They gave us a loan. We can give a description of the loan here if we want. It's 5% compounded monthly and amortized over 4 years. Okay, what does that mean? Well, if it's amortized, that means it's going to be extinguished, or it's going to go to zero over this period, 4-year period. And the interest rate that you plug into your calculation is going to be 5% compounded monthly. Now, fortunately, you have a calculator that you're going to learn how to use that's going to be able to do calculations like this. Now, I'm pulling up the Excel workbook that you're going to learn how to prepare this module, but let's just use it for our loan here. Our loan was $25,000. Okay, since we don't have any down payment, we'll just hit 0 down payment. Our interest rate is 5%, and the loan period was 4 years. So our monthly payment on that loan is going to be $575.73. All right, so minimum payment is, let's look at it again, $575.73. Okay, then we'll save and close. This description is optional. It's just to help us in the event that we forget something about the account. So we save and close. And this is our initial financing. Essentially what we did is we went to the bank with a business plan, and we convinced the bank that we're going to make money off of this plan. And the bank said, fine, I'll give you some money to use and open an account for us. So the payment method is cash, and the amount was given is $25,000. Okay, this is a basic deposit. Now the most important thing that you do when you're working on QuickBooks, because this program is designed to capture information from people who don't ordinarily have training in accounting, it tries to do things automatically. For example, it thinks today is the 7th of January. Well, it is in the real world, but not in the Accounting 231 world, where if you look at your homework, this is February 1st, 2013. That is the most important skill for you to learn for the entire QuickBooks curriculum. You have to make sure that every transaction that you complete has the proper date on it, or you're going to screw up your work and be frustrated, and your tests are going to be wrong, and just fill in the blank. Anything bad that happens will likely have happened because you forgot to set that date. So let's double check. Bank of Laie, 25, it's a note payable, date's right, save and close. There we go. Alright, so there's a check given to us in the homework. It says, at this point your balance sheet only has 2 items, cash of $25,000 and a long-term liability. Well, let's go look at the balance sheet. You can look at your accounting statements by going to the Reports tab, Company and Financial. There's a large selection here, but we want to look at a standard balance sheet. Now, a balance sheet is a picture in time. Again, computer thinks today is the 7th, but in Accounting 231 world, today is February 1st. So we'll refresh on that new date, and here we go. The Bank of Laie has $25,000 in it, and we owe the Bank of Laie $25,000. And since our net assets are 0, if you subtract our liabilities from our assets, there's nothing there, then we have no equity. So we have no owner's equity, we just have a loan to the bank. We're going to build equity when we start to have income. Alright, we did the first transaction right. We don't need to memorize anything. February 1st. Next transaction. You go and rent an office at the Laie Professional Building. Security deposit of $1,500 and first month's rent of $1,050 are paid to Hawaii Properties via check number 1 from your Bank of Laie account. Okay? Checking is handled in the banking section of your screen. Here's your checkbook. Click on it. Right? And it's helpful to read what it says. Write checks for an expense that you have not entered as a bill or a QuickBooks, or you can use the checkbook to record a cash transaction. Right? So we're not going to print our checks. They're designed to be printed. We're just going to put a number on it here. We'll put number 1, and it's going to be a new party. It's going to be a vendor. It's going to be our landlord, actually. And it's Hawaii Properties, Inc. Now, whenever you do a new person, it asks what the opening balance is because it thinks you might be putting an old company into QuickBooks for the first time. You're not, so this date is irrelevant. But just to get in the practice of always changing that, I'm going to change it to February 1st. Okay, now we have the date, check number, everything's right. Now we have to tell the program what the check is doing. Well, the check is going to be split into 2 separate accounts. One is to account for our security deposit. Well, the security deposit belongs to us, even though we can't reach it because of our contract with the landlord. So let's go up here. I don't see security account. So we're going to add a new account, and it's going to be an other account. It's going to be some kind of asset. Okay, and there it is. Security deposits paid. So other asset. Just remember that one. So we continue, and it says other asset, and we're just going to call it security deposit for office. Okay, and that's going to show up on our balance sheet. So I save and close, and the amount of the security deposit was $1,500. Okay, and I'll put on the memo line, security deposit for office. Now that's only part of the check. We have to pay our first month's rent. So we click on the next line, click on the arrow, and I'm quite sure rent is here. Rent expense. Click on rent expense, and we know that we're going to spend $1,050 in rent. So here's our first month's rent. And let's put on the check security deposit $1,500 and first month's rent. There we go. Now, let's double check. February 1st, check. We got the right time. Check number 1, $25,550. Good. Our accounts, security deposit, and rent expense are good. Save and close. That's done. Now, if we made a mistake, we'd go back to our checks. We'd hit previous, and it would pull up that check. Okay? Just in case you made a mistake. All right. Next transaction, February 2nd, 2012. The office needs furniture, so we're going to go buy some furniture. It's another check. All right? Check number 2. The date is now the 2nd, and we're going to go buy furniture. So we'll have a new vendor, and the new vendor is Honolulu Business Supply. And even though it's irrelevant, I'm going to change the date here just to show everybody to get in the habit. Okay, and we're going to write them a check for 2 things. One is office furniture. So office furniture is going to be furniture and equipment. It's a fixed asset. So I'll put $1,700 there. Office furniture. And $300 of supplies. Now, this is paper and paper clips and rubber bands and things like that. And the way accounting for supplies works, when we buy them, they're still assets. We're just trading one kind of asset, cash, for another kind of asset, supplies. At the end of the year, we add up all of the checks we wrote to supplies, we subtract the value of whatever's in our closet, and what's left over is our supply expense for the year. But that's a little more complicated. Right now, I just need you to know that supplies, office supplies, are not an expense yet until we use them. Okay, we're going to put them into some kind of other asset because it's not appropriate to expense them right away. We'll add new, and we'll say just some other asset here. And we'll continue. I think it's a current asset. Other current asset. Continue, and we'll say office supplies. Oh, it's already in use. Okay, let's look for examples. That doesn't help us. Office supplies already in use. I'm not seeing it. It probably just doesn't like this. So we'll call it office supply inventory. How's that? So we'll go and we'll create current asset, and we'll call it office supply inventory. Okay, good accountants don't expense things until the period in which they are used. It's your matching principle. And our $300 worth of supplies. So I'll just say stock the supply cabinet. Okay, and I'll put on our memo furniture and supplies. So let's double check. It says we write check number 2 for these 2 things. Good. It's the 2nd. Save and close. Alright, let's go to February 6th. We made a deal with a cable company to supply fiber optic. That will allow you to sell high-speed internet. Okay, write check number 3. Check. Automatically comes up. February 6th. To a new vendor. This vendor is Trans-Pacific. And I don't need to change this, but I'm just going to do it so that everybody can see and be careful about that. Alright, so Trans-Pacific. What are we going to get from them? We're going to supply a line, and we have to make our first payment. So this is for 6 months. So this is going to be an expense because it's going to be eaten up this year. And this is going to cost us $1,500 for 6 months of internet connection. So we're going to hook up right at the source. And this is internet connection. Trans-Pacific, oh, I should put 6 months just in case. You never know, sometimes your checks can be the only records that survive because the bank has them. And you might want to make sure you always keep a good memo line. Happened to me once. Alright, save and close. Now we have another check. We have check 4 on same date. This one is to Island Tech. Island Tech for running the fiber line to the cable hub. Okay. Now this one can be a little trickier to account for because it's going to produce benefits over the lifetime. So you might, if you are the accountant here, you might want to have this become an asset that's capitalized and amortized as it's used. But for today, we'll just call it an expense. We'll call it a computer and internet expense for $2,000. So set up the fiber optic connection. That's a, let's see, fiber optic connection. The decision whether to expense or to capitalize is something you'll get into in your 201 class. But for today, we'll just make the decision to expense it. It's right date, it's $2,000, save and close. Alright, so now, February 8th, we're going to send a purchase order. Okay, here's purchase orders. That only came up because we went to edit, preferences. And we said that we're going to use, in the company preferences, we said inventory and purchase orders are active. So if you don't see those on your screen, that's because you didn't go back and set them. Purchase order is an offer to purchase. It doesn't have an accounting entry. It's the 8th now. It just creates a paper trail to show that you ordered something. And then usually what will happen is the company you ordered from, here is California Data. It's February 8th. This is not necessary, but I'm going to do it just to be careful. Set the date. Okay, so back to purchase orders. They don't create an accounting record because this is just like phoning them and saying, hey, can you send us a bunch of stuff? Then they will to send it out. But I want to teach you how to get an inventory item. So we're going to click on the item and we're going to add a new. And there's a list of things that come up. Service, parts, assemblies, all kinds of stuff. Fixed assets, like our office furniture. So we're going to call this an inventory part because it's an independent, it's just a router. Okay, we can call it, I didn't give you a number, but if I did, you'd put it here. XYZ123. And we'll just call it a wireless router. Okay, and it costs us $100, and we're going to sell them to our clients for $200, and that'll be sales. Okay, now this information down here, I don't have to set this, but I will just so nobody gets confused. You can set a reorder point so that the program will automatically tell you, hey, it's time for a new purchase order. You're running low on routers. That's the router item. And I'm going to buy 20 of them. Okay, and it looks like it's helpfully figured out $2,000. We haven't put sales tax in yet. We will later. This is a business-to-business transaction, so I don't think we need to collect sales tax here. But just in case you're wondering, we will get to that. So we'll call on our memo line, purchase of wireless routers. Okay, it's just a purchase order. So we'll check it, send out. Okay, good. And here's where QuickBooks gets annoying. Yes, it's 30 days in the future, but we're sure we want to do it. So that's done. Now the next thing that happens is they send you the inventory. Okay. Now, we didn't send a check with our purchase order, so we're going to get our inventory probably with a bill. And if I read my thing, February 15th, receive routers with a bill. Pay the bill on the same day. This is how you set up a bill. First thing you do is you set your date. Bill came on the 15th. That's important. And then you look at your vendor. Well, we bought these things from California Data. And it tracks and it finds out that, hey, there's an open purchase order. So I'm going to receive against that order. Yes, so I click it. And now it pulls in all the information that we put on the purchase order into the bill. And since there's no terms given, we haven't learned terms yet, I'll just put due on receipt. So here's our bill. It's filled it all in nicely for us. We check 15th, 2000, save and close. And I've changed the terms. Let's just hit no. Okay. So we pay the bill on the same day. Now here's where you really would be helpful to have a pencil and be marking up your transaction list, because if you forget to pay the bill, your numbers are not going to be right and you're not going to get credit for this. So I hit pay bill, it remembers it, there it is. I look at the date is right, there's no discounts or any other problems here. We'll assign a check number. It looks like we're going to be on check 5, so we'll put check number 5 down. Pay the bill. Check number 5. Okay. So that's done. We don't have any more bills. We're done with that one. So we can check that off. February 19th. Today you signed up a customer. Customers are going to give you money. That's what your business is about. You can either create an invoice, which is a bill to send to your customer, and then you'll receive payments on that later. Or you can create a sales receipt, which is a cash receipt. Well, we signed them up, and we're going to do a cash receipt. So our first customer, we'll enter them into the record, is Kaneohe Pawn Shop. Kaneohe. And I don't have to do this, but I'm just going to do it so that nobody gets confused. I'm going to change the date to the 19th. Okay, I'm going to change the date on the receipt to the 19th, because that's the date of our transaction. And they paid us for a router. Okay, that's in my system. I can just say one router, and $200 comes up. Okay, and then they're going to pay us $500 for the first month's service. Well, I haven't put that in yet. Okay, now look, I can always pull this down and get more of those blue-white lines. But now I've got to add a new item, and it's a service. And the service is internet service. That's what we're selling. So I'm just going to say for 1 month internet connection, we're going to sell those for $500. Because we have a gee-whiz fiber optic line and fastest internet you'll ever get. And the account is sales. It's our income. So we hit OK. And we're just going to say that there's 1 month worth of that. And we can print a message, thank you for your business. We could put anything we want there. Now here it's important to remember that QuickBooks, we're dealing with all these screens, but these screens are really a computer view. In the real world, we'd be sending documents out that look like this. And we could put graphics on them, we can put all kinds of information. But just don't forget that QuickBooks is more than just a computer screen. It's actually creating the paperwork that makes business work. So payment, we're going to get cash, I believe. Yes, they're going to pay cash. Okay, and when they pay cash, we have to deposit it the same day. So we're going to save and close. And then we're going to go to our bank, and it's going to say, hey, you collected some cash. So we'll just click on that, and it'll create the deposit for us. Check the date is right. This is also a very common mistake. If you forget to deposit your cash, you're going to have undeposited funds on your balance sheet. and are not gonna your cash is not going to be accounted for correctly. So I've done that right. And because that was a sale, now I can go to company and financial, profit and loss, income statement. I can change the date. Remember, I have to go all the way out into February and then refresh it. Okay, I just picked random dates so that I would stretch the coverage of this accounting statement to cover all the transactions I did. And here we can see the sale. We can see that we sold them something. Our cost of goods was 100, and we can see the expense we've already encountered so far in our business, and we're behind by $3,900. That's what it's like to get started. So far, so good. Okay, February 20th, we sign up 2 new customers. So let's do this again. And our first new customer is Wall and Wall. It's the 20th. So even though I don't have to, I'm going to do this just so nobody gets confused. It's the 20th. And Wall and Wall are going to get their internet service and a router. Okay. They're going to get 1 router and 1 on the internet service. So we say thank you. Sale to Wall and Wall. Presumably cash. They could have given you a check. Yeah, let's say they gave us a check and it was just check 400. Okay, there's a good way to put that on. So we'll have the check and we'll save and close. And then we're going to have another one that same day. And this one is to Oahu Properties. And I don't have to do this, but I'm going to, just so nobody gets confused. Alright, and this sale is identical. It's service and a router. 1 month, 1 router. And that's the sale to Oahu Properties, Inc. And you don't have to do a message, but it's always nice. So save and close. Okay, now we make the deposit of the money that we've collected. There's our deposit. Save and close. So all our money is in the bank. Okay, so now we're at February 21st, and we have a loan statement showing our first payment due. We didn't set this up as a regular bill. I think it could be done either way. You can have a bill pop up every month to remind you, or you can just write a check to pay the bill. Either way. So let's just write a check. We're going to pay the Bank of Laie, and it's our first loan payment. And it looks like the amount we'll just set up for check 6, and we'll pay the minimum amount. Okay, and that minimum amount had both interest expense. The interest expense was $104.17, and the repayment of principal, which is a payment against our long-term note payable. This is the principal payment, $471.57. Now, how did we get that? Well, you'll recall that we've spent some time doing a calculator that does just that. Here's the payment. There's the interest part of the payment. There's the principal. The interest is at the highest at the beginning because that's the amount you're paying interest on. And so now you pay off $471, and this is how much earns interest for the next month. So the interest will continue to go down, and if you did your bookkeeping right at 4 years, or 48 months, 0. So that's our helpful calculator at work. Let's enter that. So now it's 576.74. Looks like we have a rounding error there because the note payable. What did it say here? I guess it just had the rounding error in it. So we'll just change this to a 6. We'll fudge it. Okay. change the note payable to 47256. Let's see here. Why is it 47256? 47156. That's 47256. Okay, now let's look at it, see if it's right. 57673, 10417, 471. There we go. Made that as complicated as I can. 57573, check. We'll say first month's interest on loan, and then first month's repayment of principal, payment number 1 on Laie Bank loan. Save and check the date. Good. Date's 21st. Okay, I think that's it. Okay, so if we've done this exercise correctly, we can do our report, and let's do a profit and loss standard. And our last transaction was on the 21st of February, so if we go to the end of February, we're certain to get it. So that is what your profit and loss must look like. Okay, now how do I upload this? Because it says here that you need accounting journal, balance sheet, and profit loss. Okay, what I do is I can either go to File, and I can say Save as PDF. So let's try that. And it came up as Save as PDF, so I'd save it Income Statement. Okay, save it on my desktop. That's done. The other way to do it, depending on where you're at, in the testing center, we're going to use a PDF writer. Okay, so it's taking forever on my computer to do this, but it looks like it did it. I could also print, but instead of sending it to my hard printer, I could select a PDF converter, or in the testing center you're going to use this cute PDF writer. So I'll use that on another one here. That's our profit loss. We'll close it. Now let's look at the balance sheet. Reports, company financial, balance sheet standard. It's now February 28th. Fresh. There's our balance sheet. There's our Bank of Laie. There's our inventory, our office supplies, our furniture that we bought, our security deposit. And yes, we're in the hole here. We have no equity, negative. All right, and that's our loan balance. So our balance sheet's right. Let's do it the other way. We're going to print. We're going to select the cute PDF writer, and then I'll print it. And instead of paper coming out of the printer, what's going to happen is this thing's going to spit out a PDF. It's taking its sweet time about doing it. Oh, here it is. So I want to save it as balance sheet, and I'm going to save it on my desktop. Okay, so there it is. Save. Alright, so hopefully it's there when we need it. And now for the third document you need. I can't grade you unless I see your accounting journal. The journal is found in Reports under the Accountant page, Accountant. So go down here and print the journal. Okay, and the journal, let's go to the right time period again, February 28th, refresh. The journal tells us everything that we did. Here's the deposit, here's the Hawaii properties, all the way down. If you don't do a journal, you don't get graded. Okay? It's that simple. Because that's how we tell if you did it right. So I'm having you do this all from the very beginning so that when it gets to the test, it's all old stuff for you. You know how to do it. Everything's good. So now let's go And let's see if my balance sheet, let's just pick one here. Let me pull up my, boy, it's a busy day here. Okay. And here's the balance sheet. It showed up. If I double click on it, that is the balance sheet. There we go. Now it's full screen. Okay, that's what you're after. I want you to take a nice long look at this, because this has all the numbers that you need to have to get credit. You have to have the accounts just as per this balance sheet. The net income, I'm not even going to look at the income statement unless there's something wrong. And the way this is being done, you have to have it completely right to turn it in. Okay, this is a competency-based grading system for QuickBooks. Do it right, turn it in, and you are done. If you do not turn it in by the 15th, which is the day before your Excel test, then you cannot turn it in for full credit ever again. It will be 5 points off of the 100 points you'll get for your final your final QuickBooks test. So get it done, get it out of the way. You have time at the beginning of the week here, and if you have any questions, contact me in my office. Good luck.